Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, everyone. How you going? Welcome to the podcast. Thanks for joining us today as we navigate property investment. I think every man and his dog's investing in property at the moment. It's absolutely bonkers. I've been at this on Smart Property Investment now for probably a decade, and I've never seen anything like it. Everyone's talking about property. Everyone wants a home loan. There's hundreds of people turning up at open homes. There's hundreds of people turning up at auctions. Where they've come from after the dire warnings of a little over a year ago that property prices were going to drop 30% by some of the major banks. Who would have thought we are where we are? But we're ending for property investors. It's a tough market. It's a bloody tough market because everyone's in there. You don't know whether or not you're paying fair value. I guess the value of a property is what someone's prepared to pay for it, but you've got to be thinking about the future. So who knows? I'm trying to untangle this web of information overload and trying to balance that with some of the dynamics and the narrative I'm seeing from the marketplace. We're having a lot of fun with it. I hope you dialed into Smart Property Investment and the podcast to help you make more informed investment decisions. When you come here to Smart Property Investment, it's unbiased agenda on our side. We just want to make sure you can make better decisions when it comes to property. We're not trying to sell you a property. So that's a good thing. You're at a safe place, and it's my job to curate and host conversations with people who are supposed to know what they talk about, and I'm pretty discerning with who I bring into the show. Today's guest, a good friend of Smart Property Investment. We've known him for many, many years. He's well regarded, I would think, and I'm sure he's happy for me to say this, as one of the better economists, property economists in Australia, Andrew Wilson. He's the chief economist of Archista. You've probably heard his name before. He's operated across this market for quite some time. Andrew, how you going? You well?
I'm really well, thank you, Phil, and thanks for the introduction. And it is exciting times, and the market's really turned on its head, particularly in terms of sentiment over the last 9 months, but it was always going to, mate.
Yeah, absolutely. Absolute madness, I think. And look, you've been at this a little bit longer than me, and you've probably got a few credentials to back your opinions and your narrative around it. Unlike me, I've got nothing. Have you ever seen anything like it?
Well, look, every cycle is fundamentally different in terms of its source and what's driving it, both supply and demand, Phil. I think we need to understand that we can't keep looking backwards to understand what's happening now in the market. A lot of, I guess, our policymakers get stuck into that groove, and mate, this is where a lot of these predictions do come from. But I always thought that our markets would bounce back quite strongly once we got out of the uncertainty of the COVID shutdowns. And really, there was nothing essentially that was impacting supply and demand in property from those shutdowns. And of course, once we had the strong rebound in our economy as well, it really did get rid of the fear factor and the uncertainty which was holding back property transactions last autumn. Now, it was interesting, even in the depth of the shutdown, Phil, we still had properties that were being sold and transacted. And I think that just showed that what was occurring wasn't really, I guess, an underlying force in our property market cycles. It was an out factor, and it was something that really was, I guess, akin to pushing the pause button in the market. And once that pause button was released, we had a lot of catching up to do. We caught up and are still catching up with all those constraints of last year. But the real issue is the fact that we've really been constrained in our property market since 2017. And that's what's driving particularly Melbourne and Sydney at the moment, is that catch-up energy, Phil. And it's not some, crazy price boom driven by outrageous lending practices and, the release of animal spirits. It really is driven by fundamental factors. And the real one that is simply the easiest to understand is that house prices in Sydney and Melbourne are just where they were in 2017. So, of course, there's good value in the market, because without having any price increases in 3 years, affordability is at higher levels. You consider that over the last 3 years, we've had 6% increase in incomes and a full 1% fall in the mortgage rate. So, of course, there's plenty of capacity to push prices up without it moving into a sort of an unaffordable area. And that's that drive that comes from higher income potential and also lower interest rates. That means that we can purchase more for property. So it's just like releasing the dam, I guess, that's been across the flow of our property markets. And that's why we're going to see a strong this year, Phil. But once we absorb those catch-ups with incomes growth and lower interest rates, markets will start to ease by the end of the year. There's still some constraints. It's not still a great market for investors in terms of their ability to find finance. Banks are becoming a little bit easier in terms of lending to investors, but it's been really, in my opinion, an unconscionable credit squeeze that's been placed on investors since 2015, really.
Yeah,
and investors have become sort of persona non grata in the lending community and with banks. And I think this has really been cloud cuckoo land stuff to some degree, but it's still tough out there for investors to take advantage of a rising market.
Yeah, and those are the constraints you're talking about in the market, and that is government regulation, APRA-initiated restrictions on investor lending, right? They wanted to get investors out of the market, slow the speed of growth down, et cetera, et cetera. Now, property economics 101, supply and demand.
Yep.
Right. If there's more supply than what there is demand, there's pressure on prices. If there's little supply but a huge demand, upwards pressure on prices. Now, you're talking about this backlog of intent. So there's a lot of backlog intent in terms of purchasing.
Yep.
But what I'm hearing there's still not a lot of supply on the market.
Yes.
So what's going to happen? What's going to need to take place for everyone to go, shit, I'm going to put my house on the market now to try and swallow up some of that demand? And when's that going to happen? And what's going to be the trigger point?
Well, we're seeing that now, Phil. I track new listings in real on a daily basis, and we've seen a remarkable surge in new listings just over the past week, with sellers obviously wanting to take advantage of that strong competition for property coming into the market. And new seller numbers this year so far are around about 17% higher than over the same period last year. So got to understand that most sellers are buyers and buyers are sellers. And those that are selling now will be looking to buy down the track and vice versa. Those buying now will be looking to sell down the track. But it's all about, catching up with what that sort of lost opportunity with those constraints that have been put on market activity over the last 3 years. But you're absolutely right about supply and demand. We have an imbalance, Phil. One of the factors that was a clear consequence of the credit squeeze that was put on investors from 2015, particularly from APRA, of course, was the fact that we saw a collapse in new construction. If you look at the apartment approval cycle since 2015, it's followed sharply downwards the decline in the number of investors in the marketplace. And at the moment, we're approving around about half the apartments that we were in 2015. And we're still, despite the government home builder policy, we're not still back to the levels of home building or house building that we were 3 years ago. So the point is that we were heading for significant undersupply in our housing markets as a result of this. It's very difficult to catch up with supply when it falls below demand. It takes a while to gear up, particularly the apartment market to gear up, new apartments to gear up to match demand. And the only thing that saved us from this happening not sooner rather than later is we are seeing a collapse in migration. So less demand from particularly overseas migrants, students and tourists means that it's actually going to help in the short term to ease the imbalance between supply and demand. But it's still there, Phil. It will get worse going forward. And, the established market just will reflect that underlying imbalance in supply and demand that has been caused by those outside policies that constrained lending, particularly to investors and developers.
Yeah, and I'm happy you brought up the immigration part of this equation, and we'll get into that a little bit later. We've got about half an hour, Andrew, so and we're going to be stuck, mate. You're going to have to get back on to get more commentary because me and you could chat all day. A couple of things we want to achieve. I just want to make sense of this current market, how you can actually start creating a strategy as an investor in this market, a quick sort of around the ground, and then those segments you think are worthwhile considering as an investor. And I want to touch on the migration as well. We'll get into that in a moment. We'll scale break beforehand. Back in a moment.
Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investors Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Andrew Wilson. He's chief economist at Archista. Andrew, how do you make sense of where we are right now? If you're a property investor, I'm a property investor. You're no doubt a property investor. We've got tens of thousands of property investors listening to this. There's so much noise out there. It's hard to make a decisive call on where and what you should be doing right now. What pieces of information are gold dust for property investors in this market to help make informed decisions?
Well, we want to know, Phil, in real time or as close to real time, what's happening in the market. A lot of the price data that we get is backward looking. It covers quarter. And of course, a sale isn't really telling us exactly today what market sentiment is. I tend to look more at listings data, more of a real time reflection of the market. And also, it's very important to look at the end auction clearance rates, Phil. We know it's been a strong year to start that. Well, this year's started very strongly because we've seen some almost extraordinary results over the past 2 weekends to start the season. The Sydney market last week, the first, week in February, was the first week in February, so the first week of the autumn selling season. Sydney recorded an 89% clearance rate, for goodness sake. Now, that's the highest clearance rate that's been recorded on a Saturday since May 2015. That's any Saturday. Wow. And it's the third highest clearance rate ever recorded by the Sydney market. Just a handful of properties we're talking about. There were over 400 properties put under the hammer last Saturday. And of course, that means it was a reasonable test. Now, tests will increase with more numbers coming in. And as I mentioned previously, listings are surging. So the depth of buyer activity or buyer talent will be tested in coming weeks. But at the moment, you'd be pretty game to say that there'll be fewer buyers than sellers going forward. But Melbourne also had a plus 80% clearance rate. Adelaide and Canberra been strong. Adelaide was 90%. And Brisbane had just under 70% clearance rate, which was lower than the rest. But Brisbane typically has clearance rates around 50%. They have a different auction culture there. And to get a clearance rate that high shows that it's a very strong market in Brisbane as well, even though they have a much smaller proportion of auction activity compared to total sales. Now, all these are indicators for those that are looking at the market that this is a hot market early days. And if you keep looking at listings data coming through, as well as that's the newly listed homes coming through, the number, as well as those weekend auction clearance rates, you can get a feel for how the market is tracking, and also, the prospect for higher prices, as well as, you can see which parts of the capital city markets are doing better. And it's interesting at the moment that there's really no weak spots in the market, Phil, in terms of local markets, regional markets. And, it's really a very hot market. But as I said, there's still plenty of upside. And, we're already starting to hear the bubbles inflating and it's going to burst, and all those sort of asset bubble nonsense stories, which we've had no historical precedent for. And yet, of course, this is the other end of the pineapple in terms of the scare campaign that we get in property. No bust, just a crazy boom. But, as I said, I think that the data is clearly showing us and understanding the data, where the market is now and where it's likely to head.
So some really good points there, Andrew. And one of them is that most people will fluke a good buy in this market, to your point, because most markets, or pretty much every market, is doing well. It's going to be hard to get it wrong. So it's where you choose to get the greatest bang for your investment buck right now is what the best investors are doing. So you don't inflation. I've got a strategy. You've got a strategy. Most investors have some sort of strategy or philosophy that they approach investing to, but you're up against a competitive market right now. So a lot of the flexibility, a lot of the pragmatism you might have had at once upon a time, probably not that relevant in this market. So you're an investor, Andrew, and this is just general. You're in this market right now. You want to get involved. It's your first time in property investment right now. What would you be doing to be successful rather than fluking it?
Yeah, well, I don't think that's everything's rising. I think we'll get just about every market with a 10% increase in median house prices this year, Phil. I think that's the sort of energy we got. We shouldn't be too concerned about that because, as I said, we're really in catch-up mode anyway and getting back to where we should be. But I think yield is very important to look towards, Phil. I think yield is a good guiding point for investors looking for the higher yields. Now, of course, as you get into areas which have outer suburban and regional areas which have higher yields, some of that can be masking other factors such as low demand and rentals that are not increasing. Now, I think that your first point of call would be to seek out properties which have higher yields, and typically they are more affordable and have lower entry points. But I'd also look at the correlating factors, such as the number of vacant properties there in terms of rentals, the actual rental movements in recent periods, and also, of course, the vacancy rate, which puts those together. And I think you can create a simple model then in terms of opportunities, and then you just sift through and do some more on-the-ground homework in terms of local economic performance. So I think you can take a scientific approach to this, Phil, rather than just sort of throw a dart at the dartboard. And I think you start at yield and then at factors such as the number of vacant properties in that particular suburb, the rental levels when rentals have risen or fallen, and of course other factors such as days on market and the actual price itself of the property. But I think the first issue that investors have to get right is to get the finance right, and that's really been the struggle. So I think do your homework and hunt around for finance. And I think that investors, when we look at the market, there are a couple of weaker points in our market, despite we're sort of pretty gung-ho here. And there's no doubt that there's some weaker spots in investment markets in inner city and inner suburban Sydney and CBD Melbourne. Now, there's very high vacancy rates in those areas at the moment. And that, of course, is a factor that's been driven by the issues with coronavirus shutdowns. We've had closed borders, both international and, of course, state borders. That's restricted business travel, tourist travel. Student demand for rental properties from internationals isn't there. We've had a second highest year for first home buyers on record last year. So they're not renting, they're buying. So it's really been a drop in demand in these areas, which particularly are geared towards, and a lot of Airbnb landlords, Phil, have found it difficult, obviously, to find those short-term tenants, and they've moved into the permanent market. So there's been a flood of supply as well as a steep falling away in demand last year. Now, that's meant rents have fallen quite sharply in some of these areas, some suburbs down by 20%, and vacancy rates are quite high. In fact, unit vacancy rates in total in Sydney and Melbourne are now at record levels, but that is fundamentally being driven by those inner city and CBD apartment markets. So I think they're areas where we're still not seeing, I guess, a fire sale environment from investors who can't match their outgoings in these particular areas, either with difficulties in finding a tenant or having to reduce the rent. We haven't seen that occur yet, and there's still quite reasonable buying activity going on in those inner suburban unit markets in Melbourne and Sydney. Now, it's coming from owner-occupiers, downsizers, first-home buyers, empty nesters that are still pretty happy to secure a property in the CBD or adjacent suburbs. But I think that the test will be for those markets for this year will be when the mortgage holidays start to ease from the banks that a lot of investors have taken advantage of. And the latest data shows that there's been an easing in those mortgage holidays, a significant easing, the mortgage holidays that the banks offered to their customers. But most of that easing has come from owner-occupiers. And investors are still holding quite a high or a much higher proportion now of those loans that are in pause mode. And I think that's because, they're still under pressure in terms of matching their outgoings. So what happens when, those holidays finish, I think will put more pressure on investors. Now, this is specifically in those areas I mentioned. So what I'm saying is this, again, you look towards those fundamental measures of activity. Obviously, yields are still quite reasonable, although falling in those areas, but vacancy rates are very high. And that's and also vacancies are very high, over 20,000 apartments vacant in Melbourne and Sydney at the moment. But this is mainly an inner city area. So I'm saying you need to be sort of aware of what's happening on that sub-market basis. And I think the other point is, the other end of that, Phil, is interesting, is that although we've seen a sharp increase in vacancy rates for apartments, and as I said, particularly inner suburban apartments, and rents falling quite sharply in some of those suburbs, we're seeing the reverse in houses. We're actually seeing falling vacancy rates for houses, Phil, and also higher rents. And there's a number of factors there. And one, of course, which has been discussed, is that there's higher demand for larger properties now from the work from home environment. People are now saying, well, I need an extra room or an extra 2 rooms for an office. So they're looking now to either rent and own, or to move into a house rather than a unit. Now, this is putting pressure. And again, as we've mentioned, there is an underlying undersupply, particularly in houses in most capital city markets. So I think the opportunities there are reflecting those lower vacancy rates and higher prices in middle ring and outer suburban, lower priced houses, detached houses for investors, Phil. And I think that's where the energy will come, or the drive will come from investors, will be in those particular markets. And as I said, I think that you can look to suburbs in terms of, firstly, their yields, but also their vacancy rates, their price growth levels, their rental levels, how that's improving, and their prospects in terms of the local economy, to shortlist the potential opportunities on a suburb basis for investors. And as I said, I think those areas are going to be, the targets for investors going forward. So I think you just take that sort of scientific approach to it. There's plenty of data that you can find, you don't have to pay for, that can lead you to create those type of simple models as a starting point to determine where the best investments are.
Yeah, and for our more sophisticated investors, of which a lot of them listen to this podcast, and by that I mean people with sort of a medium to large sort of portfolio, any particular opportunities for them who have some skin in the game already, some knowledge, some capabilities, they're obviously in the market already, so they're going to get an uplift on that. But how should they be playing the game differently to newer investors who might just be first property or second property?
Well, as I said, I think that the opportunities are for middle ring and outer suburban properties, Phil. I think, the big drive from investors 5 years ago was apartments. But I think now we're certainly looking more towards the traditional detached house as an investment opportunity. I think there's some differences. I'm actually reasonably bullish on Brisbane apartments, believe it or not. I think those high yields in Brisbane apartments are yielding around about 6% at the moment. That tells me that prices will rise. And the point is that, yes, we can say, well, isn't it similar to Melbourne and Sydney? Well, no, it's not, because vacancy rates for apartments in Brisbane are actually falling, and we're actually seeing some increase in rents in apartments. So that notional oversupply in apartments in Brisbane has certainly now been soaked up. And I think that there are good opportunities, particularly around the riverside there, for investors looking to enhance their portfolio with what are quality stock, highly in demand, and certainly compared to Melbourne and Sydney, undervalued. Not so much the smaller stuff, perhaps away from the river in terms of the Brisbane market, but I think overall Brisbane's a very good prospect in all property types for this year for a number of factors. And we're still seeing a surge in migration into southeast Queensland. That's actually been enhanced through the coronavirus shutdown, because we've seen and a lot of anecdotal evidence that particularly Melburnians have shifted up into Queensland, into Brisbane. And that undersupply in Brisbane is quite apparent when you do model demand versus supply. So it's not just all new in the suburban units or CBD units you need to be aware of. But I do think that houses, outer suburban houses, and the other point is the demand for housing is not just about looking for more space for your home office, Phil. People are now working from home, so they don't need to commute. So they think, well, I might as well be in an outer suburb in a cheaper property, a bigger property with a bit of land, because I can work from home. I don't need to do the drive or get the train or the bus every day. So I think that that's the demand force that'll push up prices in those areas and also push up rents. So investors should be looking at those areas, I believe.
Yeah, I agree with you. And thanks for drilling down there a little bit on Brisbane, because I wanted to go around the grounds and the capitals. We'll continue that when we come back from the break, back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Chief Economist of Archista, Andrew Wilson. Now, you just did a bit of a deep dive into Brizzy. You think those riverside properties, apartments look okay. I agree with you on those middle ring suburban properties are great. Now, let's head up north. Let's start off around the ground. Yeah. Darwin, which has been bucking the trend. It's been doing all right up there.
Yeah, I think you're right, Phil. And Darwin had a bit of catching up to do. It had a massive apartment boom, as we know. We're a regular visitor up to Darwin, great spot. And it always had to soak up that apartment boom. Typically, supply moves ahead of demand. And of course, it was exacerbated by the end of the mining boom, and a lot of the fly-in, fly-out sort of left Darwin. It was a similar situation in Queensland and, of course, Western Australia with the end of the mining boom. But that's now come back as it was going to, because we've actually seen a strong turnaround in population growth into Darwin. And being a small area, shifts in population can really have a short-term impact on the housing market, different to some of the bigger capitals where it takes a while for population growth and migration shifts to impact housing market activity, particularly prices, which in those areas are more about short-term factors such as moves in interest rates. But Darwin has turned around on the back of an improved economy, but particularly more people moving in there. And of course, Phil, Darwin was perceived as a safe haven destination through coronavirus shutdown. A lot of Southerners took advantage of the quarantine policies in Darwin to move through to Queensland through Darwin from southern destinations. And that, of course, caused a spike in demand for property going forward. And we've seen rents rising again quite strongly in Darwin. But population's been a turnaround, but it was coming from a low base. It was always going to happen. It was, a once in terms of the end of the mining boom and the boom in apartments. Once that readjusted itself, the market was always going to get back. And we've got to remember, Phil, Darwin's always been a very expensive market. So, again, it's really in catch-up mode, similar to Sydney and Melbourne.
Okay, and definitely in catch-up mode is Perth, which has been pretty lacklustre for the last decade or so. Tell us about Perth. What's happening there?
Well, again, it's a similar story. I mean, the Perth market is the furthest behind its previous peaks of any of the capital city markets. Now, Perth median prices are still around 10% lower than where they were 7 years ago. Now, there's been lower rates and higher incomes over 7 years, and that's a market that's really set to start to rise, Phil, and it is rising now. Again, there's been a very strong rebound in population growth, net migration into Western Australia. Again, it collapsed following the end. More than any of the other capitals, people just left Perth in droves when the mining boom finished. And of course, that was all about the fly-in, fly-out. That left a lot of investors with vacant properties really for a long period of time, and rents fell to 10-year lows there, but they've certainly rebounded now. The rental market in Perth is one of the tightest, can you believe, in the country, and rents are rising again. It's tough to get a rental property, and again, as I said, migration has rebounded quite strongly now into Western Australia, and I think also these safe haven perceptions through coronavirus to those states such as Queensland and Western Australia are attracting people into those areas in higher numbers. And of course, that means increased demand for property. But Perth's been a great market for first home buyers over the last 5 or 6 years because prices are low, and nothing a first home buyer likes than lower prices. And of course, incomes levels in Western Australia for first home buyers in Perth are at the same level or even higher than they are in the eastern states or the eastern market. So it's been a very strong market for first home buyers. There's also a building boom going on in Perth, Phil, at the moment. Perth is building more new homes than Brisbane at the moment, which is quite astounding. So they're taking advantage of that home builder policy from the government, but there's always been a market because of its low value compared to comparative value compared to others that has enhanced building in that market. So plenty of upside for Perth. Again, I think that, it's not an outrageous prediction that we may see 10%, up to 10% prices growth in Perth. But that's only going to bring us back to where we were 7 years ago, Phil. So it might even go higher than that.
Well, let's hope so. And I know there's a lot of investors out there, and Adelaide has always been the
Yeah.
steady as she
Yes.
goes type of joint, and more of the same for Adelaide, do you reckon?
Yeah, absolutely. A very secure market, and it doesn't have the same roller coaster ride in terms of where the peaks and troughs are compared to the other capitals, but it still grows when everybody else is growing. I would suggest that, again, Adelaide on a value basis is set for at least 5% this year and likely higher. Its prices are maintained around about peak level, so it doesn't have any of that catch-up energy that we were talking about Darwin, Perth, Melbourne and Sydney's, but still it's a highly affordable market. And the positive in the Adelaide environment, Phil, has been the economy. The South Australian economy has really improved. It was always that terrible underperformer amongst the major capitals year in, year out, but it has actually improved quite significantly over recent years, although it hasn't really bounced out of coronavirus as strongly as some of the other capitals. And just talking about that, Perth had a great response to the end of the shutdown period last autumn in terms of its economy. Perth's really kicked goals since the end of the shutdown period, surprisingly, given, of course, that it shut its international borders, and that was supposed to affect its economy. But the building boom there and a lot of retail sales is kicking Perth along. But Adelaide hasn't performed as well as Perth in terms of its economy recently, but it has built quite a good base in terms of its economic performance in recent years. But yeah, absolutely steady as she goes, I think, Phil. Certainly growth in that market, but I don't think it'll reach the levels of the top performers, which is most of the other capital cities.
Okay. Yeah, and I want to get into the economic stuff, and we'll just park that for a moment. Let's kick over to Melbourne, which probably had the biggest lockdowns, the most stringent lockdowns globally, and how it responded to COVID-19. And we'll get into that in the economic stuff. But tell us about property prices there. What can we expect?
Similar story to Sydney, Phil. Melbourne is just back to where it was in 2017. Of course, it was hit around by those, the credit squeeze to investors, just as Sydney was, because it had a higher proportion. So it followed that roller coaster ride from 2017 up and down and back up again now. It's still got some catching up to do. It's the market where we've seen the most increase in listings this year so far. So it is all about those lost opportunities through the second lockdown last year in spring that Melbourne experienced, unlike the other capitals. So buyers and sellers are still wanting to catch up and make up for what they lost with the market shutdown in spring. So it's really a very heady market at the moment, similar to Sydney, but it's got a way to go to keep catching up. So I think there's plenty of momentum and potential in that Melbourne market going forward. Of course, we have the first Super Saturday of the year in Melbourne in 3 weeks' time. That's the weekend before the Labor Day long weekend holiday. There'll be well over 1,000 properties going under the hammer there. So it'll be a big opportunity for buyers in terms of choice of properties. But I do think it'll be a very, very strong day for actual number of sales in the market there. But Melbourne, I think, again, is looking at a double-figure growth rate this year. The only weak part of the market, as I discussed, are those CBD units, which have high vacancy rates, falling rents. But I think that really only works its way to CBD, Docklands and South Bank. I think once you move into the inner suburban areas in terms of particularly established units, there's still quite strong markets there and offering higher yields. And, of course, plenty of demand still for first home buyers in those particular areas. So that's, I guess, an area where investors can also be looking towards. But Melbourne is building more houses than anywhere else as usual, new houses. And again, that's an opportunity, I think, for looking at some of those middle ring value houses for investors. But Melbourne, I think, again, overall around about a 10% growth mark. The areas to be wary of are those CBD and proximity markets, apartment markets.
Yeah, and Melbourne has a long way to go in terms of growth geographically, but the predictions are that it will overtake Sydney as our biggest capital city in the soon or just over horizon future. So watch that as a dynamic. But let's kick over to Adelaide. I guess an extension of that sort of wider Tasmania. It's been the darling of growth over the last period of time. Will it continue?
Yeah, look, Tasmania tends to be a little bit of a contrarian, doesn't it, Phil? It sort of booms when everybody's busting and then busts when everybody else is booming. And I think it'll have a steady year this year. I think it's had a very strong period. We saw remarkable growth in Hobart particularly, and Launceston when markets were easing through that credit squeeze period. And I think that it's really built ahead in terms of affordability. And it doesn't have quite the same potential to grow as the other markets because it has moved so quickly and strongly above what were obviously low points in terms of its price compared to other capitals. So I still think that it'll grow this year, but I think it's similar to Adelaide, looking at around about a 5% market. But again, it's perceived as a safe haven, a coronavirus safe haven. So migration should be a pickup there or positive there. But I think even though it'll be a positive year for Hobart and Launceston, I still think we're talking around about 5 to 7% in terms of prices growth there, mainly because it's had a lot of growth in recent years.
And the nation's capital, Canberra, Andrew?
Yeah, well, Canberra's been just another superstar last year. It's been a very strong market in recent years. And I think it has plenty of upside this year, even though, as we said with Tasmania, it's maybe, had a lot of its growth, in the bag over the last few years, and therefore it won't grow strongly. But Canberra has had a lot of growth in recent years, and we've got to remember it was very quiet for a few years there, particularly given issues with government spending. And I always get into arguments with local agents in Canberra that, it's all about, local government fiscal policy or national fiscal policy that drives the Canberra housing market. Well, I'm sorry, guys, but it is. The point this year is that we're going to get a very strong local economy in Canberra because of all the stimulus packages will generate public service growth in the national capital. Now, Canberra is a chronically undersupplied market. The number of new standalone dwellings, detached dwellings, is really remarkably low. And that always keeps that market undersupplied. Wages, of course, are quite high, public service economy. And I think that's that underlying imbalance in supply and demand that will continue to push up prices in Canberra. And as I said, I think that the fact that we're getting more government spending this year through the stimulus packages means that the offset won't be a cut in government spending, which we've seen in previous governments did have an impact on Canberra. And of course, increased government spending will mean more people moving into Canberra looking for those public service jobs. And as I said, it's a market that's chronically undersupplied going forward. Although, of course, we've had a building boom in apartments in Canberra. Yeah. I think that Canberra apartments are similar to Brisbane apartments, perhaps something worth looking at with high yields and lower vacancy rates. They've stopped building apartments in Canberra, certainly at the level they did 2 or 3 years ago. And with increased population and demand, I think that we'll start to see prices rising in those Canberra apartments, and that'll tend to push yields down. But still, it's an undersupplied rental market, and I think that's another good prospect for investors. But generally, in terms of prices, and that's the unit market in Canberra, generally in terms of prices, you'll get a lower yield in Canberra, but a higher capital growth in houses. But yeah, I think Canberra's certainly looking at one of those markets again that'll be pushing up, I believe, towards 10% growth this year.
It's pretty good. And Sydney, we're going to see 10% in Sydney?
Yeah, we'll see 10% in Sydney. It started off like a rocket. Yeah. Again, it's, as I said, it's still below where it was, or around about where it was 3 years ago. There's a few other factors that are driving the Sydney market. We've got a lot of expats coming into Sydney at the moment. They are really driving demand. A lot of what happened in the prestige market in Sydney last year, we can put down to expat demand, not in high volumes, but I think that expat demand will start working its way into Sydney's leafy suburbs in the middle and upper North Shore, particularly. I think you'll start to see those sort of family-friendly, higher-priced areas, prices rising there. But I think Sydney will be right across the board in terms of higher prices. Again, similar to Melbourne, the areas to watch are those inner suburban apartment markets, which are holding up at the moment because we haven't yet seen, high numbers of investors coming into the market because they're having problems with their balance sheets. Perhaps that's because they're still being supported by banks in terms of those lending holidays. But Sydney, across the board is looking like a very strong market, and it started the year off as the strongest of all the capital city markets when we look at those auction clearance rates. In fact, we've got prices up already around 7% this year so far compared to the same period last year in terms of median prices for houses sold at auction.
Yeah, it's an interesting market here in Sydney. And Andrew, conscious of the time, but
yes,
I wanted to touch on a point you made in terms of economic recovery post-COVID and Perth doing well compared to Adelaide. I just wanted to sort of get some context from you for our listeners around, I guess, Australia's place in the world. So globally, we are a lifestyle superpower, and that's only just been reinforced more so from COVID-19. The rest of the world wants to come to Australia because it's a great place to live. Now, geopolitically, we have our challenges, but, for those of you who are sort of connecting in with national security orientated issues, Australia is taking its role very seriously in how it protects its interests in the Indo-Pacific. It is emerging as a key middle power nation who is going to be fundamentally responsible for a lot of the security of Asia during this period of time. Now, that is good for economic stimulus. It is good for economic recovery. Can you give us some intersection as an economist of how sort of global politics might shape economic advancement for Australia and how that sort of plays into property markets? Because you said right now, there's no immigration to Australia right now. So we've got an undersupply. Markets are going nuts as it is. What happens when the world opens back up, mate?
Well, we've been very fortunate, and a number of factors, Phil, have played in our favour. I think we've had a very mature attitude towards the coronavirus restrictions in this country compared to other similar countries, Europe, UK, US. We've done the hard yards, we've made the sacrifices, and, we can argue that the result of that is, we've got in reasonable control of this. And we've been able to, I guess, come out of our lockdown sooner rather than later and get on with the business of getting a job. And that's what's happened. And it's interesting that the key drivers of our economy, obviously domestically, have been, and that's where the jobs are coming from, have been retail spending and the construction sector, particularly retail spending. We've had a remarkable year last year in terms of the growth in retail spending. We're now tracking post-coronavirus shutdown at significantly higher levels of retail turnover than we have just about ever. Well, obviously ever in terms of dollar value, but the growth has been the strongest we've seen for over a decade. And I think that's, we've got on with business, but we've also adapted to change. We now buy online. That's created industries. We see Harvey Norman and JB Hi-Fi and Officeworks have had fantastic years last year, but it's not just a blip, it's continuing on. And I guess that consumerism is a very positive factor. Now, we've seen other markets where obviously construction is very strong. Perth actually has had, or Western Australia has had the strongest result in terms of retail sales and construction. And that's what's been driving that economy. Now, the big picture, of course, in terms of our relationship with the rest of the world is our trading position. And Australia is fortunate that we have a very strong resources sector. Now, the resources sector, although not creating a lot of direct jobs, as it won't ever again, because we won't be building the mines and the ports and the railheads that we did back during the mining boom era in 2010 through to 2015. But we certainly are gathering and improving our current account position. We had record volumes of exports of iron ore last year. Iron ore prices got towards record levels as well. Coal is still a big driver of export income for Australia. And this is all helping us to, I guess, promote our fiscal position and spend our way into prosperity, which everybody else is doing. But in a sense, we're doing it better than others because we have this ability to be a trading, in terms of resources, a trading superpower. And with a very small population, this is just what we need at the time. And guess why our dollar's pushing towards 80 cents, Phil, which is remarkable. Maybe won't get to 80, but it's a tick of confidence from international investors in the strength of the Australian economy, is how strong our dollar has been. And a lot of that is through our resources sector. Now, we've had to deal with these, as you mentioned, geopolitical issues, particularly with China. That's going to be an ongoing issue. I think we've just got to remain a little bit circumspect about this. The main game is to recover our economy through what's going to be a very challenging period over the next few years without getting too embroiled in those geopolitical issues. As I said, we are a major exporter of those resources, particularly that China needs. I'm not saying we should, in any way, reduce our standards in terms of what we expect in the international community, but the economy is the main game. It always will be. And we've done so very, very well so far. And, who would have believed that we, starting to look like getting an unemployment rate with a 5 in front of it sooner rather than later, Phil.
Absolutely crazy. And I'll close this question, Andrew, sort of long-term thinking. And, you've given us a bit of a state of the market as it is right now and how it's going to pan out to the near future. Yeah. Let's look 10 years ahead and Australian property. Is it worthwhile sticking your money into it today? You can't go too wrong.
I'm not a great tea leaf reader, Phil. Yeah. It's, all those that make longer term predictions always end up having to backtrack probably within weeks because things come out of left field. And as I said, that's the issue with economics. Economics isn't a statue, it's a living entity that changes as we all change, as civilization changes, and we've got to adapt to those changes. But I think that in any 10-year period going back, Phil, if you asked the same question and then you looked forward as we can now in what happened in 10 years' time, you'd want to have your money in property, wouldn't you? For sure, mate.
Absolutely.
I think that given the prospects of being an undersupplied market, which we are definitely an undersupplied market and will be chronically going forward, and the fact that we're going to have low interest rates for years to come, even the Reserve Bank acknowledges that, and by low we mean near zero, and it means that, the interest rate genie that is the only factor that I guess jeopardises housing market activity in the shorter term, that's back in the bottle, mate. We don't have to worry about interest rates anymore. It's just about local factors of supply and demand, and that means basically people moving from city to city, state to state, and the amount of houses we're building to match that. So I think that means that property, with its consistently higher yields and with all those tax incentives that will never, I believe, be removed, what else would you have your money in, seriously, going forward in terms of an asset class? And, I think there's a lot of realisation in this low yield economy, low interest rate economy, that property is now actually becoming preeminent in terms of what the level of income that it produces compared to other asset classes.
Yeah, well said, Andrew. And we don't want to be too much of a flag wave for the property sector, but go and look at the facts, and it looks pretty good right now. Andrew Wilson, Chief Economist at Archista, thanks for your time today. Appreciate your insight.
My pleasure, Phil. It's been a great chat.
Nice one. We'll see you again soon. Remember to check out smartpropertyinvestment.com.au. Plenty of this sort of stuff. Go and check it out. If you're not yet subscribing to our daily morning newsletter, say the first to know what's going on in property, smartpropertyinvestment.com.au/subscribe, or social media, Smart Property HQ. It's where you'll find us. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.